really should be ECB and Bank of England live. We've got the Bank of England press conference happening in the background with Governor Bailey and Jim Broadbent, among others. They're laying out their case for raising interest rates by 50 basis points and what sort of messaging we got from the Bank of England. So before we dive into the European Central Bank, we'll just have a recap on the Bank of England and what it did. We saw the Bank of England raise interest rates by 50 basis points, signalled it could tighten further should the situation arise. And the vote was split 7-2, so the two usual dovish suspects preferring to not raise rates, and the 7 other members voted to raise rates. There was a hint that maybe they're approaching the top of the hiking cycle. The market seemed to be trying to figure this one out a little bit, as I said in the commentary that's just gone out. Let me just get that for you so I get it word for word. So they added that the risks, they would tighten further if inflation were to persist, and they said that the risks are significantly skewed to the upside for inflation, but also lowered the estimates for medium-term wage growth. Now that's important because the market is not necessarily looking at whether it's a 25 or 50 basis point hike. More on that with the ECB coming up, but it's looking at the sort of medium-term outlook for inflation, and a lot of that depends on where they think wages are going to be over the next couple of years. So lowered the estimates for medium-term wage growth, hinting that the bank thinks it's near the peak on inflation. Just like the Fed, we're back to data dependence. I think that's really what we're driving at here in terms of the central bank narrative that we've seen over the last sort of year. Banks racing to catch up. The central banks basically allowed inflation to get out of control. They said it'd be transitory. They sat on their hands, did nothing whilst they watched inflation get higher, and then suddenly they realized they had to do something. They raced to catch up. They've been racing at quite a clip, 50 basis points, the same 75 basis point hikes from the Fed. And they've caught up. Basically, they feel that they're close to catching up. They're just slowing down like a ship coming into harbour, turning off the engines and just drifting into the port. At least that's what they hope to do. The other side of the equation is the data, and I think what we're now going to look at is less about what the banks say about what they're going to do, where they think the terminal rate is, and more about what the data is telling us, just how sticky inflation is and how much wage growth continues. Back to the MPC, raising its benchmark to a 14-year high. And if I just scroll down here, on inflation, says risks are skewed significantly to the upside, but thinks inflation has peaked, sees inflation down to 3% in 1 year time. Wages, revised its wages growth forecast lower, so they're seen up 2.25% in Q4 2024 from 2.75% that had been forecast in November, and down to 1.5% in Q4 25 from 2% 3 months ago. On growth, it sees a much shorter, shallower recession. That's because energy prices have come down, and also because market pricing for interest rates have come back down from September, and that has important repercussions for mortgage rates and rents. On the market side of things, we saw cable spike higher up to 124, almost 123.90, then retreated. We saw a leg lower, 122.7, just broke down there, and we're at now 122.98. So just holding on to 122 handle. Cable really struggling for much momentum at the moment. It had, of course, had a pretty good rally. It's had a good run up of late with the dollar softening. And we've seen it just top out of this 124 kind of region here. If you can see on the charts there, this is proving a fair bit of resistance up here. Although we have got momentum still. Momentum still looks quite good, but we've got this MACD bearish crossover in place. So with that resistance being met and time again, and with the dollar maybe just seeing some coming back eventually, it will eventually come back, is what I mean. We keep seeing it make new lows, and the trend is to the downside on the dollar, but we think that probably there'll be a snapback in the dollar once people realize that the Fed is going to be more aggressive than they had thought. Coming into the European Central Bank meeting, We're expecting a 50 basis point hike from the ECB, and maybe we'll get some signals that they're going to do more. Let's just have a quick check on our preview piece, what we said. We also think Christine Lagarde might signal 50 basis points in March. And in December, she had signaled 50 basis points in February and March, basically signaled 100 basis points. And that was what sent the euro higher, as really the ECB sounded more hawkish than really it had done for any time that I can recall. Wednesday, we had figures that point to persistent and broadening inflation. So Eurostat's flash index down to 8.5%. Headline good, inflation coming down from 9.2% the month before, and below market expectations. And it is a marked deceleration from the 10.6% that we saw in October. But core inflation remained unmoved at 5.2%. And then we think the ECB will want to see a much more sustained decline in core inflation before it's willing to signal a pause or signal a slowdown in the pace of rate hikes. Lagarde's been pretty steady, although there's been mixed messages across the central bank. That's pretty normal with the ECB. You've got a wide range of hawks and doves. It's not like a normal central bank with a core of committee members. It is the heads of the different central banks in Europe, plus some other members. She outlined 100 basis points of hikes from March. Little to suggest that she'll deviate from this. The doubt really is further out along the yield curve. So again, going back to what we said about the Bank of England, how far out do they see inflation coming down in 2024, 2025? That's really what is going to matter to market interest rates and the euro. It's not really where inflation is today or tomorrow. It's where it's going to be in a year, 2 years, 3 years' time. And that's really what the market's looking at. It's looking at the belly of the curve. The curve, as we say, so the yield curve reflects the path of interest rates, expected interest rates over the course of a time frame. Any time frame you like, from 10 to 30 years, whatever it is. And at the moment, we're just seeing that sort of belly of the curve flattening, and it's just sort of looking at that to see whether we see some movement in that belly, to see if there's any movement in the euro and inflation expectations. So any change to statement released ahead of the press conference will hold clues, so we'll have a look at that when it's released in about 5 minutes. In the December statement, the ECB said interest rates would still have to rise significantly and at a steady pace to reach levels that are sufficiently restrictive to ensure a timely return of inflation to the 2% medium target. This was a big change from the substantial progress that the ECB had hailed in the October statement. So there has been a shift. The data has moved, and the central banks have had to catch up and change their narratives. Since December, disinflationary trends are taking hold, and that is going to allow the banks to be a little bit more optimistic. A little bit of a signal that we're near the top, just as the Fed tried to signal. Close to the top, we think, maybe close. Not that bothered about what's happening. Suggesting that financial conditions had loosened. That was Powell's message last night. That's, of course, by most measures, simply not true. The market, financial conditions in the market have tightened and are back to where they were about a year ago when the Fed began hiking interest rates. So it's a slightly different story in the EU, but nevertheless, the central banks seem all too quick to jump on the idea that disinflation is taking hold. Just as they said transient rates will be transitory, now they're saying, oh, it's fine, it's coming down. Disinflation, wages won't be sustained. I think this is the key. The structural weakness in the labour markets of developed economies means we will get structural inflation from wage growth, which will continue to move up. So base case today, no staff forecast today. They come out in March. So we don't anticipate any sort of messaging, particularly around growth or inflation outlooks, any change to those anyway. Lagarde relies on, and the Governing Council in general relies on the staff forecasts. A 50 basis point hike is expected. Indication very likely to do similar in March. That's the base case. A nod to quantitative tightening with APP seen ending this year. That's the base case. A hawkish outlook that we could get from the ECB, given the inflation dynamic, the core inflation dynamic, and the increase in French inflation that we saw. Lagarde could warn on inflation persistence, sticking firmly to 50 basis points in March, so 50 points today, and saying definitely another 50 basis points and perhaps more after, hinting at more hikes required beyond then. a dovish outlook. This seems less likely at the moment, but from the Bank of England to the Fed, we're starting to see the narrative that maybe they're hitting the peak of the cycle. So the dovish outlook is inflation is slowing, growth is contracting, not as badly as thought, 50 basis points, but not committed to another, and that they could slow to perhaps to 25 basis points in March. I think that would be the dovish sort of messaging that we might get, is this idea that it may be appropriate to slow the pace of interest rates in the near future. I think that would be a message that we'd look for, to look for a bearish case for the euro. If you get those phrases, it may be appropriate to slow the pace of interest rates in the near future. That would be a clear signal to me that the bank is sounding a little bit more dovish for the time being. So we're just waiting on this number coming out, the release, and we should be out any second now. And we're just looking at these updates, and we'll have the euro just coming out in a second on the 5-minute chart. As I say, expecting 50 basis points. We'll be looking to see whether or not that's what follows through. Come up here. Always just refreshing the tabs to make sure that we get the update as and when it comes through. And that's 15, so we should be getting our update now. Euro shooting higher, so actual 3% versus 2.5%, so actual 50 basis points as expected. Marginal lending facility 3.25 versus 2.75, yep, 50 basis points there. Euro just drifting higher. Deposit rate facility again up 50 basis points to 2.5 from 2%. So we're getting the messaging from the ECB seems, or at least the policy decision is the same. And if we just look at the expects to raise them further, now that's interesting because in December, as we said, still have to rise significantly and at a steady pace. So they just said they expect to raise them further. And it will then evaluate subsequent expects to raise interest rates by another 50 basis points in March. So clear signal in March, 50 basis points. That's interesting, but maybe it's 50 basis points and then slow and stop. Keeping interest rates at restrictive levels will over time reduce inflation, blah, blah, blah. And just looking to see asset purchase program. Continue reinvesting full until the end of Feb. Yep. Subsequently decline at a measured and predictable pace. The decline will amount to 15 billion euros per month on average until the end of June. Subsequent pace will be determined over time. So nothing particularly on that APP that's different. But I think this idea, clear signal of 50 basis points for not just today, but for March. The March meeting is now nailed on 50 basis points. So we have to see a very sharp change in the data to change that. But it's laying the framework and the path towards slowing down quickly thereafter. And that might just be a problem for the euro going forward, that maybe the ECB thinks with this 50 basis point hike in March that it's now nailed its colours to, that will be enough. So we'll see. It doesn't say that it expects to pause anytime soon. It does say it will keep, expects to raise them further. But that could just mean March. That could just mean the 50 basis points in March. Doesn't mean further, as in beyond March. We wait to see. So the euro just moving a bit higher, but I just question whether or not the euro can sustain that gain. I think there's a question mark now whether the ECB does 50 basis points in March, then stops. And if that is the case, and if that's what the market starts to bet on, then we have a new dynamic for the euro dollar cross. And in fact, we could be seeing the dollar coming back. But we'll wait and see. Christine Lagarde press conference coming right up after this one. Thanks very much for watching. And just to recap, both the ECB and the Bank of England have raised rates by 50 basis points as expected. Not too much volatility in the market at the moment, but we are watching Christine Lagarde's press conference coming right up at 1:30 UK time, 2:30 Central European time, and that's going to be coming up shortly. Euro dollar just touching 110 there on the spike higher on that sort of 5-minute chart. That's because the bank has said 50 basis points is coming in March, but it has also suggested that it will pause thereafter. At least there's an insinuation, I think, from reading the statement that it could be pausing immediately after that March meeting. So I think a dovish hike probably is how to cast this one, but we'll wait and see. And the euro now sharply weaker there, just giving up those gains and retreating. So lots of volatility in euro crosses right now, and we'll keep you updated. The press conference will be live on the platform on X-Ray. That's coming up in approximately 10 minutes. Thanks very much for watching.